Welcome to the discussion. The slides provide valuable information to a person who like to analyze why share market move up and down. It goes into basic reasons and motivates students to predict and identify the bulls and bears phase in the stock market.
The slides gives both positive and negative indicators. While positive indicators push up the stock market, negative indicators pulls down the stock market. Although the case focus on Indian stock market, but the basics are applied in general.
We start our analysis from the year 2015 to 16. Since then, the stock market progress has been phenomenal, as both NSE and BSE figures have more than doubled in the last 7 years. We analyze the factors that help the stock market to reach such a height by identifying the key players and their roles. The first important factor is government policies. Policies provide the necessary inputs for controlled growth and act as triggers for up and down movements in the market. Based on policies, foreign institutional investors or domestic or common investors decide to invest their money based on their risk-return expectations within a time horizon. The second important factor is foreign institutional investors. In the financial year 2015 to 16, although they are the net sellers withdrawing, negative 44,908.94 Indian rupees crores, and due to this, the Nifty lost 851 points during the year. In 2016 to 17, FII came back with 25,361.67 crores purchase, but still, it is less than the domestic institutional investment by 4,569.87 crores. From the data, it is clear that they are the net seller from 2017 to 18 to 2020 to 21, and during COVID-20, they came back with a huge stock purchase of 201,377.26 crores, whereas during the same period, D2 was the net seller. Due to the huge investment, the Nifty rise by more than 6,500 points, whereas the 21,800 points jump was seen in the BSE index. The situation reverses in 2021 to 22, where FII are net sellers withdrawing the huge money and D2 are purchasing simultaneously. The third important factor is domestic institutional investors. Except in the year 2020 to 21, their investment in the market is greater than the foreign institutional investment. They continuously support the stock market even when FII is withdrawing money. Using the public coffers, they are employing the funds so that the Sensex reaches new heights. The fourth important factor is common investors. The stock market rally, where the market doubles in 6 to 7 years, provides plenty of opportunities to earn a huge amount to attract common investors. Companies like Zerodha and 5Pays, operating on low brokerage charges and providing simple tools to invest and earn, give a common man who is sitting on cash in the form of savings and deposits wings to dream high within the risky market, which look attractive due to continuous bull run. The fifth important factor is domestic savings. Domestic savings play an important role in a country's growth. In the absence of limited foreign inflow in the form of foreign direct investment and institutional investment, savings provide investment capital for industrial development. Domestic saving, investment, in India is divided into two parts: public saving, investment, and private saving, investment. Private saving, investment, is further divided into two parts, and those are household saving, investment, and corporate saving, investment. The saving rate has steadily increased over time, from an extremely low base of 9% in 1950 to 51 to 37.7% in 2007 to 2008. From there, it slowed down and declined to 28.23% in 2020 to 21, also, gross domestic saving as a percentage of GDP continued in a downward direction from 30.6% in 2015 to 16 to 28.9% in 2020 to 21. The downward trend means that citizens are using their savings for a reason. It can be for personal consumption or for personal investment. The retail participation in Indian stock markets is rising, says an SBI report, pointing out that 44.7 lakh retail investor accounts have been added during the 2 months of this fiscal. The number of individual investors in the market has increased by a whopping 142 lakh in FY21, with 122.5 lakh new accounts at CDSL and 19.7 lakh in NSDL, the report said. Also, the share of individual investors in total turnover on the stock exchange has risen to 45% from 39% in March 20, as shown by NSE data. In order to predict stock market movement, one has to study all positive and negative factors and correctly analyze the position before investing, and gains come from true prediction while losses accumulate if the prediction is wrong. I encourage you to note down the positive and negative sides of all the factors and apply them comparatively with the timeline, and you will realize that the stock market follows pattern, but may bring in surprises when economic and financial tools are used to gain more than intrinsic value, all because of human greed. Because of it, sudden fluctuations take place. For further discussions and an easy understanding of economics, do subscribe and stay connected with the channel. Thank you.